what is AI and machine learning and how does that interact with finance research. So the reason I want to spend like 4 or 5 minutes about this is because I do get comments from audience saying AI, machine learning is kind of remote to our academic research. It's still intangible. I want to just give you guys like 3 works I'm doing right now. And one of the work I will spend most of my time to discuss the details, motivations. So if we can look at the screens for people in the room can look at the screens. For people online, friends online, you guys can just to see my shared screen. So I just want to briefly talk about the 3 works I'm doing right now in terms of how AI and the finance research can be combined. So the first one is what we do is we measure how much the financial reporting are read by machine instead of human. This is actually a paper made me know Miko. Miko invited me to present at his web seminar last year. And that's how the research connect people. So that's how we get know each other. So basically in that paper, we want to show that when the annual report is read by machine, not by human, manager trying to cater to machine to make machine readers happy instead of human readers happy, and we develop a lot of measures on that. And this is one thing. This is AI implication for managers. The second one is more related to asset pricing. So what we do is we build a robot analysts. So the robot analyst at any certain time can crawl the firm's information in a fast 5 years, including all the news data, annual report, and the financial statement data. So basically, the robot will make a prediction, and we horse race that robot prediction with human prediction, human analyst prediction, and we see which one is better, which one is superior. So the reason I said this one, it's an AI implication for investors, because we found like the robust analyst can actually beat about 53 of human analysts. But our story is not that about that. Our story is how come the rest of 47 humans survived. We found several interesting stuff. We found that human can survive if they know institutional background of the industry. We see humans survive when there's a small sample, training sample for the machine. The machine needs a big training sample in order to get the patterns out. So, and also we see humans survive when humans understand the firm management team, R&D, intangible information. So basically in the paper, what we do is we show why humans survive, find human has its advantage, understanding all this soft information. So what we did is we did a third part of the paper. We combine human strengths with machine strengths. So we build a system which has the ability of process high dimensional information, as well as humans soft skill of understanding all soft information. So we build a hybrid one, and we found that one wins everyone. So it beats human, beats machine. So so these are the 2 projects I was talking about. The first project is how AI affects managers. The second one is how AI affects investors. So in the second one, our message is you don't have to worry whether the fundamental analysis will be replaced by machine. What we should worry is how can we acquire some skills that are incremental to machine. So as long as human can maintain some incremental skills that are incremental to machine, we can survive. We can work with machine together. Instead of we are competing each other, replace each other. So that's the message we want to give out. And so this is something two applications how AI apply to finance. One is for manager, and another one is asset pricing. Yes, Nico.
Yeah, question on the second paper. Can the Zoom crowd actually hear me? Okay, good. So the question is, because you about this incremental skills that humans need to acquire. So I guess if you take like the longer perspective, one problem is that the boundaries of what AI can do are actually expanding.
Excellent, excellent point. Excellent point.
So is there some sort of limit in your view?
Yes.
Or will the field for humans keep shrinking and shrinking?
So that's an excellent point. So basically the story here is that the human incremental value may change over years, because as development of the AI, knowledge graph, the reasoning, because the most of the advantage we see here is human has the reasoning logic, which machine doesn't have, and human has the artistic design, like a feeling, like machine doesn't have. Would that incremental value fade over years? Possible. We don't have an answer for that yet, but at least for the last decade or 2 decades, it will be the case. We still have an incremental value, and what will happen after 2 decades, we'll start worry about that after maybe 1 decade passed. So, but that's a valid point. That's a valid point.
Well,
yeah.
One thing I can think about is like the existence of machines.
Exactly.
So at least we have to propose what we buy.
Yeah.
How could you serve me better? So that is definitely one path we need to do.
Yeah, exactly. So maybe eventually the profession, if really the upper boundary, the machine develop its full potential, maybe we only have like artistics left. We don't have filmmakers, like music musicians. Maybe our paper, our academic paper, machine can crawl all the SSRN and combine all the papers together, generate another one, submit to GF, and the GF referees machine too, machine review. And we just developed the machine. We just developed the machine. So coming back, the third one is what I'm trying to talk about today. The third one is, so you guys know my background. I was computer science major for a while before I move on to finance and accounting. So when I was a computer science major, I was thinking about what's the most difficult things to understand. I thought it was like, I was sort of as theoretical physics. I thought it was like rocket science, but over time, as my life experience accumulates, I feel the most difficult stuff I'm struggling to understand is humans. It's the nature of the human. That's what I found. So in this one, what I do is we use machine learning to model human decision. That we trying to, let's say, understand what I'm talking about. My next decision, you can analyze my educational experience, my historical decision, my personality. Do I like IPA beer, Swedish beer, or do I like other stuff from my food taste? From all my information, you can understand my decision-making process and evaluate my decision. This is the paper I'm going to present today. And we're going to spend time on it. So just overview, you can see that there's a lot of good things. You can combine AI and finance. These are just 3 projects I'm discussing here. If you're going to see more, you can see my Google sites there. And Google Sites has my all other AI research, machine learning. I just want to give like 3 overview of the examples, and you can look at more on this on the sites. So let's go into the third paper. I was talking about how we use machine learning and AI to understand the human decision. So I want to give a very brief overview of the one page overview. I'm sure you guys have read the paper. We have so many stuff. We have a convolutionary neural network. We have a dimension reduction. We have feature selection. We have the grouping. We have a lot of technical stuff and theory stuff in the paper. I know it's a little bit overwhelming, so I'm going to just use one slide. I'm going to summarize what's the paper about, and then we'll go over each bullet point and along the way. And also I have a flight at 4 p.m. So the good thing about this one slide is if I finish one slide, you pretty much get 80% of the paper, and the rest of 20% we can go details. So I can in case we can finish on time, but I'm still want to deliver the whole message to you guys. So let's see what are the 4 things we did in the paper. The first one is we want to model the human decision-making process using AI. So we'll talk about that, how exactly we model it. And another thing we did is we want to see how machine evaluate human different from the human evaluate human. So basically, if the machine understand my decision by evaluating my educational background, my food taste, my travel preference, how exactly human understand me is different, evaluating me is different from the machine evaluating me. Let's say you guys are selecting PhD students. I talked to a PhD student today. So you have two options. One is have machine to select a PhD for you, or we have a Miko and Nan and Sarah to select, all friends online you select. So how the people you selected is different from the machine selected. That's one question we're asking in the paper. Just give you guys a little bit over what we found is, we found machine select human based on very complicated non-linear relationship between the person's experience. So for example, let's say why my talk makes sense here. It's not just because of my educational background. It's because my educational background interact with my personality, interact with my expertise. So there's a non-linear relationship between the individual's feature. The machine trusts on that part, and our model capture that part. While human evaluate human based on most, we found relation based, like, oh, this guy from great university, this guy is like a good reputation with someone else. So this is kind of human evaluation is a little bit different from machine evaluation. We want to model that to show you guys the difference. And so exactly what setting we did is we look at the analyst setting. So let me explain the setting a little bit, and you guys can see exactly what we are testing. So let's say I want to use a Swedish company here, IKEA. Okay, IKEA is a public company, right? It's public. Okay, so let's say we have 40 analysts following IKEA. They're trying to make a forecast about IKEA. So the question we're asking about is, before we know the actual earnings announcement of the IKEA, can we know out of the 40 analysts who I can trust for their forecasts? So the 40 analysts are making forecasts for IKEA, and we don't know which one we should trust, which one we shouldn't trust. So before we know the truth, can we figure out which analyst we can trust? This is actually the model we are trying to build. And then I will tell you guys what we did. So basically, we look at the analyst, the historical accuracy, experience, effort, the firm, the IKEA characteristics, and micro, the inflation. We look at all variables. It's about 665 variables, 65 dimensions to model whether which of the analysts who are following IKEA can be trusted by just by machine evaluation. So what's in it for it? So someone may ask me, well, if you pick up out of 40 analysts, let's say you can really pick up someone you can trust for their forecast. So what? So I'm challenging myself, what's in it for it? Like, what we want to sell. So this is the list of things we want to sell, and we'll go over details, but like I said, I want to use the first one page to make sure the whole picture of the paper are clear to everyone. So by the way, if anyone have questions online, let me know. If you raise question, I may miss your raising hand, but I'm sure Sarah and Miko will help me to monitor if any of you guys have questions. So so these are the stuff I think it's important to investigate the question. So first, what we do is, let's say if you can really know out of 40 analysts, you pick up the one you can trust. One thing is for investors, you can generate abnormal returns. Because if the one machine pickup make the most accurate forecast compared to the rest of 39 analysts, by following the analyst who can make the most accurate forecast, you can generate a return as well, because the rest of us do not know who is following. So the first thing is it actually generates significant return by following the one machine pick. So that's for investors. There's a abnormal return we can generate by using the pickup, understand the analyst decision making process. And then another thing is there's a literature in it. There's a post-revision drift. It's normally has been puzzling for a while. We found that this kind of stuff, our results can kind of help to explain the long-term puzzle of the post-revision drift. We'll talk about that later on, just let you guys know, just to address so what issue. So first, we can generate abnormal return for investors. And the second is it resolve a anomaly which has been puzzled for a while. And another thing is, another implication is, what we have is right now, right before the earnings announcement, normally we use the analyst consensus as a proxy for market expectation of the news before news announcement. That's what we do now. So what we're trying to say here is we can generate a new consensus. Let's say out of 40 people, we can pick up the 3 best ones we can trust in the future. So instead of aggregate the 3 people's announcement versus aggregate 40 people's earnings forecast, the 3 persons consensus will be way more accurate than the 40 people's consensus. So that's another message we want to send out is when we aggregate information, it helps. Before we just aggregate the 40 analysts forecast together, there's a lot of noise in that aggregation. But now what we do is out of 40 analysts, we pick up the most powerful 3 ones, ex ante. And instead we get the 3 analysts consensus. Instead of using the 40 analysts consensus, you get a much clean consensus compared to the 40 consensus. And we think this one has great implication. So I don't know if you guys use Yelp in Sweden. Do you guys use Yelp? Yelp, Y-E-L-P. So how do you guys find like a restaurant is good or bad? Like, do you have like a review, like a restaurant review stuff? Google Maps. Okay. Okay. So this is the example. So in States we use Yelp. Yelp, people give reviews. This is good restaurant, bad restaurant. The problem is we don't know who to trust. Like we don't know like people saying good, people saying bad. Always mixed view, right? So this is also another implication this paper can apply to. If I analyze the contributors' historical features, we can figure out whose comments we can trust. Like Miko recommended some Swedish food yesterday. So if that's the comments from Miko, I would say, wow, this is comments I should trust. Yeah, I'm sure Sarah and then. But if someone else gives some comments, maybe we should just ignore. How do you aggregate all the 1,000 reviews together to generate the best aggregated information for the restaurant? So I think our method is not just for analyst study. It can be applied to any information aggregation. So for example, elections. I know you guys have you heard the US was like election process was a little bit dramatic, but the idea here is, let's say we have the political polls, like people can make a forecast about the election outcome. So we have 200, 300 entities making a forecast. So how we can exactly aggregate all this information together and we can trust what's the really outcome of the political election. This is another example of the methodology we provide today. We can aggregate online discussion. We can aggregate the political forecast. We can also aggregate the microeconomic outlook. So I heard the Stockholm University has very good econ department. That's even finance department. They have guys very good. So let's say economics to make a forecast about the micro conditions, but different people have a different opinion, right? So how we aggregate all these forecasts together so you can have the best GDP forecast of the Sweden. So this is also another implication I think the paper can provide. We provide a methodology, can aggregate all the individuals' opinion together and form a smart consensus. So that's the 4 things. That's the 4 things I would say. I think that's some point of the paper. Generate alpha, resolve some puzzles in the market, and we can get the smart consensus, not just about analysts, can be online discussion, political forecast, microeconomic forecast, and also we have a methodological contribution. So I just want to spend a little bit time here because we're trying to get more technical afterwards. So this first slides, we'll move to some models. Before I move to some models, I just want you guys know what we learned from applying machine learning to finance research. So we found is when we apply machine learning to finance research, you need a domain knowledge. It's actually similar to what we discussed earlier. So if you just use the most cutting edge computer science model into finance, it won't work. What we need is we have to use our domain knowledge to select a model. We have to use our domain knowledge to select the input of the machine we call features. So the domain knowledge is very important when we combine the machine learning with the finance research. If you just completely rely on a computer scientist, it won't work. We try that. We just completely, we don't put any domain knowledge, just use most cutting edge computer science machine learning model to run this. It doesn't work. We have to have finance knowledge to select the model, to select the variables, to select the data. That's important. So that's also give us a hope, right? One day you will say, oh, all finance professions will be replaced by computer science scientists. The answer here is no, because we need the domain knowledge to apply this model. So we are good. We are good here. So another one is local nonlinear interaction. So I talked to Abby today. So it's very difficult to interpret this black box machine learning model. How exactly they get better performance? How exactly the machine can, let's say machine can pick up the one out of 40 that we can trust in the future. How exactly machine do that? So we developed a methodology to interpret the machine learning. We're trying to unwrap the black box using our own developed interpretation method. So another methodical contribution is we want to unwrap the black box using a way this is something also computer scientists will not care. When I was a computer scientist, what do we care about is performance, efficiency, like accuracy. Is that 90%, 95%? Like every incremental 0.5%, you can publish a paper. So let's say I have an accuracy at 90%. Someone have a 90% 0.5, that's on the paper. Someone get a 91%, that's on the paper. But that doesn't work here, right? We want a theory. We want theory. So what we did is, as a business researcher, I provide interpretation for black box model, and so you guys can see what is going on. The third thing is the model we are using is actually for imaging. The convolutionary neural network is actually for imaging because the variable need has an order. So we also create a way to apply image model to numerical model. So that's also something we invented. It's something also computer science have less interest, but it's great application for business researchers. So this is just the whole overview of what I'm going to talk about today, in case I have to miss anything. So any questions you guys can raise, and yeah, go ahead. Yeah.
Yeah, you were talking about generating sentences, and you pick 3 out of 4 analysts.
Yeah.
Why don't you? I mean, I'm just curious why didn't you assigning weight to the analysis?
We sign. So basically, so we did a continuous and discontinuous. So continuous is each one has a weight, right? We just aggregate them together. Discontinuous is we have the above the certain threshold, it's picked, it's good. Below the threshold, it's bad. So we tried both. Yeah, does it make sense? Yeah. So the 3 one is just discontinued one, right? Yeah, we did a continuous as well. Yeah. So let's move on. So let's skip some of the stuff. So this is like this gentleman was asking. May I have your name?
Yeah, just call me Ouyang.
Ouyang. Yeah. Okay. Yeah. This is actually related to what Ouyang asked. So the I is individual opinion, right? I is individual opinion. So what do we have is alpha is the weight on each individual opinion, right? So what we want to learn is we want to get alpha on each analyst for certain time, certain firm, and for certain individual. So this is a dynamic model, which means so my opinion will weight high given time and firm. So basically, this is the weight is changing based on. So let's say if I have expertise about IKEA, I may not have expertise on another Swedish company. Volvo. Yeah, Volvo. So basically, my opinion, how you should trust me based on time, based on the firm, and based on me. So these are the dynamic changing of the opinion. So what we want to do is we want to use machine learning to learn the alpha. We want to get the alpha out. That's the key of the paper. We want to get the alpha out, the weight out, which is dynamic, dynamic model. And we also we want to show is what's the implication, how to interpret the machine, which is I discussed in an earlier slide, right? That's another thing. So one thing you may ask me is, why use analyst setting? Why not just use Yap? Yap was the food ones, the review ones. Why not just use the economic forecasting aggregation? Like, so maybe you guys maybe have the question, if I think this one has so many applications, why choose the analyst setting instead of other setting I was referring to? So there's several reasons we choose analyst setting. The first one is it's good to get the each analyst has a forecast. So that's an individual opinion, right? That's an opinion. The opinion variable is available. We can use that. Okay. There's another thing is there's two important things in this machine learning training model. The first thing is we need to know the individual's historical feature. So for example, if you study me, you need to know my educational background, my research interest, and blah blah blah. It's easier to obtain for analysts. For analysts, you can obtain the historical forecast accuracy. You can obtain the effort. You can obtain the brokerage information. You can obtain everything about analysts. That's the input for the machine for us to train. But think about the review, online review, the contributors. Let's say Miko post online something online about a Sweden restaurant. The problem is we don't know about something about Miko if he just posts online. We don't know. We only can know. We don't know his age and career and the stuff. How should we rely on a person? So that's another thing is we're using the analyst setting because the individual feature is well available, and that's one reason. We use the analyst setting. But the most important one is the later one. For analysts, we can tell the decision quality. So for example, if analyst forecast is close to the ex-post earnings announcement, that means that's a good quality, right? If it's far away, that's bad quality. But think about online review. So Miko posted some review online. How can we tell if Miko said this is good restaurant? How can we tell what's the judgment for the Miko's review? He thinks it's delicious. Of course I agree, but Nam maybe disagree. Sarah maybe agree too. So it's very objective, subjective in terms of evaluating the food comments, the stuff. But here it's straightforward because just by looking at the error, like looking at the forecast earnings, comparing with the announced earnings, you can easily see the forecast quality versus using the online review, online stuff. It's very subjective to tell whether the Miko make the right comments or wrong comments. So this is reasons why we use analyst setting. So we basically want to use the setting. We can test this, but once the methodology is available, you can apply to other settings as well. So so this is basically the analyst setting we are testing. So so one reason normally I will talk about something. So one reason is why we want to use machine learning. Why just use OLS and stuff? So two answers here. I'm kind of asking myself and answer myself, but anytime you guys want to jump in, you can feel free to jump in. Yeah. So just comment like we are organizing like a conference for real financial studies, and we receive a lot of machine learning and fintech papers. So one thing is raised from the audience and the review process is why you want to use machine learning. Why don't you use traditional ones? So first of all, there's two ways to make an argument. The first one is the machine learning model here is because we have a lot of nonlinear relationship here. And later on I can show you guys. So traditional model will not capture the nonlinear relationship we're talking about. So let's say if you trust my decision, it's not just because my publication record. It's because my publication record plus my personality plus my blah blah blah. There's a lot of interaction going on. That's why you can trust some of my decisions. Same as analysts. So so the traditional machine learning model couldn't test that. This is one reason. The second reason is we want out of sample prediction. So again, I want to say we are not saying out of the 40 analysts who we can trust. We are not talking about history. We are talking about who we can trust in the future. So that is important. So most of traditional methods do not have the power to generate the out of sample prediction. So we are not talking about the 40 analysts who can trust now, we just who can trust in the future. So that's the machine learning will come in handy when we do the optimization for out of sample prediction. That's another important thing. So there are many things we're talking about. These are the two main things. And also we also horse race with traditional methods. So later on you can see that we are not just using the convolutional neural network. We use convolutional neural network. We plus the traditional ones. We want to show that it works well, and we want to show empirically it works well. Why is that? So this is we do incorporate the traditional method and trying to see the advanced machine learning tools works better. Yeah, works better. This is so I just want to give like a very simple overview of the neural network. We're talking about the convolutional neural network, but let's just give you a very like a snapshot of what is a neural network, and you guys can see why it works for us to figure out why we should use the model. So so this is a picture. Very quickly, this is a picture. So, and this is a neural network, deep learning. The reason we say deep learning is this is one layer, right? If it is more than 2 layers, will become deep. If it's just 1 layer, it will be machine learning. So it's like some basic concept that 1 layer is machine learning, more than 2 layers, it will be deep learning. So this is a neural network. So basically mimic the human thinking process. So let's say in our brain, we have all this kind of neural. This neural can process information, and layer by layer, layer by layer. So the input of the model is the pixels of the picture. The picture has like millions of pixels, right? So basically you input the pixels into the model. It's like a OLS. You put all the millions of X in the OLS, but of course OLS cannot run the millions of variables. Neural network can. So you put the pixels in, and in the neurals. So this one's called neurals. In each neural we have an activation function. The activation function, good thing is help you to filter down the bad information and retain the useful information. So we call that dimension reduction. So in that case is once you put the pixels in and you do the dimension reduction, you take out the noise information, retain the useful information, you get all the layers. So from pixels, you got layers from this new activation function. And once you are layers, you keep retain the useful information, rule out the noise information, you got all the corners. And if from the corners, you keep going, you get all the small objectives. And you get that, you keep doing that, you can recognize, oh, this is car, this is person, this is animal. So this is the process. This is the process. Your neural network can recognize this is a person with sunglasses with a hat. That's the process. So you can see that, you feed the neural network with voluminous information, noise ones and unnoised ones, and from layer by layer, the activation function at each layer will retain the useful information and rule out the noisy ones and get the pattern. Once you get a pattern and move forward, each layer can give you more information until you identify your objects. So that's the neural network is how it's working. Someone was maybe asking me like, how do you know what are the noise information? How do you know that? How do you know this is new useful information? How did the neurals can get the edges out? And how do you know the edge are useful information? And from edge to corners, how do the machine know corners are useful information? So this is a process which OS do not have. Is we call the cross validation. So in the cross validation, it's like think about like we are taking the exam, right? You take the exam and you compare your answer with the true answer is wrong, and then you learn it, and then you take the exam again and again and again. You can later on can show your graph. After you take like 2,000 of the exam, you will learn the pattern of the exam, and you can do well. So this is a multi-stage optimization versus OLS. One-time optimization on a R square and an error, sum of the error. So this is like a multiple reward, like you do it and check an answer and come back, reward, check an answer, come back. From that process, machine can figure out what's the useful information and what's the noise information and identify the lines objectives. So this is the model we are doing right now. And the basic principle of neural network. Yeah, Miko. Yeah.
Question maybe. Can you give an example of an
The OLS. Yeah, you can even put OLS, so it can be any function, and that's the parameter we are tuning. So you can put any function in a neural to help you dimension reduction. If it's not right, you can change to other function. Yeah, yeah.
But this function is from pixels to the output, or
yes, output. So it can be OLS. You can put OLS in neural. Just people don't do that. But theoretically, you can put anything here, and then the machine will train until it found, hey, this is the right activation function to use. So this is like say parameters you can do. But normally we don't change the activation function. But theoretically you can put anything here. Yeah. Okay. So so we talk about stuff, some of the stuff here. So let's talk about some like variables. So what variables we are putting into the model. So for the analyst level, we have 15 features. So basically, the analyst following experience of the firm, forecast horizon, consensus, blah blah blah. There's a lot of features we are talking about. So and for the firm level, we have 40 features. So basically, size, book to market. So it's IKEA size, IKEA book to market, and Volvo momentum. So these are the firm level features. So we want to show that this is something firm actually matters. And also micros like inflation, oil price, all these. So basically these are the features we put in a model. It's like pixels we put in a model. But you know what's important is, like I said, the interaction between these variables are most meaningful interpreting the model. So we only have how many variables? We only have 67 variables. It looks like OLS can handle it, but the thing is, the interaction between all the 67 variables, that's the meat. That's the insights we want to capture, and we only can use convolutional neural network can capture that. So this is one things we want to talk about. So this is the validation I was talking about. So what do we do is we divide the sample into the training sample and the validation sample. So we first use the training sample to train the model. So Miko was asking like what's in the activation function, right? Do we put OLS? Do we put a random forest? Do we put a gradient boosting, or do you actually put a conventional loss function in there? So in the training sample, you keep learning. You have the model to learn the pattern, and once you learn, and then you use the validation sample to test whether it is correct. If it's not correct, you have to go back to keep tuning the model until the prediction will be correctly validated using out of sample. So this is the cross validation process. So basically, we don't use in sample to validate them. We set aside of random sample and use the random sample to validate whether the model can predict out of sample prediction in an accurate way. And then, so that's the process. So basically, we are not talking about the in-sample optimization. We want to make sure the machine can predict something accurate out of sample by taking out of the sample run. Yeah, go ahead. Yeah.
So we can also do the thing using LS. So why does learning help?
Because the parameters like OLS, you don't have much flexibility with the parameters, but here you got all the layers, you got all the activation function, you got all the learning rate, you got all this. So all these parameters have the flexibility to capture the fundamental pattern of the data. OLS, once the feature variable is fixed, there's no much optimization process for you. Yeah, that's a big part of it. Yeah. Yes, yeah, this is. So, you know, the lasso is a machine learning. It's a very just simply modify the OLS. Usually put the penalty function on OLS. So that OLS has the flexibility to tune the model. So OLS can be a machine learning as long as you introduce parameters to OLS, and but the procedure will be the same. Yeah, just model can get more and more complicated. Yeah, the neural network is the most complicated one, but with a little twist about OLS, you put some activation some penalty function, you can be a machine learning too. Yeah, go ahead.
Yeah, I'm wondering about overfitting here.
So this is a random sample, right? Okay, this is a random sample. If it's a random sample, it naturally, you know, address the overfitting issue, right? Yeah. So we are not using in sample to optimize. It's out of sample. We take this out of training. No, this is not in our. We don't use that for training the model. We set the random sample aside to test for it. So yeah. So so we have accuracy. You have F score. This is the way to value the model. So so we did a comparison of different accuracy. So you see like so linear model here, like logistic regression stuff. So basically, what does the 53% mean? 50% means 53% means we want to show that out of 40 analysts, we pick up the one. With the machine pick up the one correct, the someone we can really trust. So this is like a so if you do random guess, it's 50%, right? Just, you know, if you someone can trust, if you random. So linear model is like a random guess, a little bit above the random guess. So what we have here is the 70%. So basically 70% of chance machine picked analyst can be trusted for their future forecast. So this is this is the model where we have end up with around 70%. So some of you may ask me, why don't you improve it? Why don't you improve it to 90%, 95%? Well, after 3 years, this is the best we can do. Yeah, this is the best we can do. We just, it's just after tuning the model and stuff, after all the feature selection, this is the bottleneck we are facing. This is 70%. It's good enough. It's good enough to generate returns. Good enough to form the smart consensus. But like Miko said, maybe in the future we can improve that. So you have questions?
Yeah. So one dimension where the ranking is actually reversed, and that the regression does way better is on the recall. So is that somehow meaningful? What does that tell us?
Yeah. So the type 1. I don't know the answer yet. But right now, what we are focused on is the accuracy and the F1 score. So F1 score is the combination of accuracy and the recall. So you can see the F1 score here is 72. So basically on F1 score, even if we consider recall, these two are the best model we have. So yeah. So we cannot, like you said, we cannot completely rely on accuracy. We have to look at recall, but we also cannot completely rely on recall. We have to look at accuracy. Just by combining the two parameters, the measurement together, just if you look at the F1 score, it seems like the two models are pretty good ones. Yeah.
Well, how do we define the accuracy? What's the economic motivation?
70% means if we choose the machine choose the analysts, will be 70% of chance the analyst will beat the rest of in the future beat the rest of 40 analysts median forecast.
So
yeah. Yes. That's how we define it. Yeah. Okay. So here comes like so here comes the model and the nonlinear. So you guys thinking why we need a machine learning, why we need a nonlinear model. So the thing here is when we explain the neural network, I kind of skip something. So for the neural network, we put the whole pixels into the model and you do the dimension reduction. That's neural network. But convolutional neural network, the difference is you only scan. I don't know if the people online can see me. Online convolutional, you only scan local area, and you understand that's local picture. And then you scan again, do the rolling. And then once you understand each local picture, you understand the whole picture. Yeah, that's what convolutional neural network about. It's compared to the neural network. The reason is that if you put the whole picture into the neural network, there's a lot of noise interaction. For example, we don't need to know this is sunglass by looking at here, right? You can tell this is sunglass by looking at this mouth, this has nose, this has hair. By looking at local area, you can tell this is sunglass. Yeah, but if you use neural network, everything will be interactive with each other. Everything. So you have some noise interaction here. But only look at local picture, you actually get more information, you get more useful interaction from the sunglass to the nose and stuff. So that's why the convolutional neural network and neural network difference is they look at the local scanning local, and you get the information from local to avoid unnecessary global interaction. That's the idea here. So okay, so one problem here is the picture has orders, right? If you scan the picture here, you can always scan. You know how to scan from right to left to right. You have as an order. But for our variables here, you can have the variables here. We have, let's say we have the 10 variables here. How you order it will determine the model. So let's say scan local. If you scan these two locals, you get an interaction of the two locals, right? If you scan these two locals, you get interaction with two locals. So the interaction between the forecast value and the experience general, this one will never be interactive with each other because they stay far away from each other. Does it make sense? So let's say here, the sunglass will never interact with this another the chair because they stay far away from each other, right? That's the idea. But the picture has the order. You can do that by scanning. But the variables doesn't have an order. When you run the OLS, do you order the variables run OLS? You do not, right? But here matters because depends on how you order them, you get different interaction. Like I said, you only get the interaction for the labeling variables. If the two variables are put aside from each other, you don't get the interaction from them. Yes, you can do that. So one way Lan was suggesting is you try all possibilities. You get all the combinations. Think about this, how many possibilities we have. If we have 10 variables, we almost have 1 million possibilities. And so far, we still don't have the computing power and the stuff. And so this is we have to get the order before we can run a convolutional. That's what I was talking about. The model is used for graph because graph has the order. We want to use the graph model into the numerical. We have to make some changes. Yeah, we have to make
Is that something where domain knowledge would help?
That's exactly the point. That's a good point. So that's exactly the point. So to cut it short, I think I'm going to just cut it short. We use domain knowledge to group them, and we found within group the order doesn't matter. So that means we group right. So basically the idea is we group the variables into groups, and we found among groups the order matters, but within groups the order doesn't matter. So we're kind of showing that using our domain knowledge, we put them into groups, and the groups is right because within group the order doesn't matter. That means we group them in the right way, and by grouping them, we kind of do the dimension reduction. We reduce the possibility of the possibility of ordering, so we can exhaust all the orders to get the nonlinear interaction. So this is accuracy. This is like within group doesn't matter. So let me go over some empirical results so you can see. Oh, this is one thing. How machine evaluate human is different from human evaluate human. So this is how machine evaluate human. This is how human evaluate human. So when human evaluate human, you see brokerage size. Right? Because so this like the most important is the how renowned is the broker. Yeah, go ahead.
A clarifying question. So where do you get the human evaluation from?
From the institutional investor. So every year they rate star analyst. So we use that from the human evaluation. Yes, yes. And this is the machine evaluated human. So you can see that they focus on accuracy, blah blah blah. They so kind of more hardcore. And like I said, most important is the interaction. The machine focus on the interaction between these features, versus human more focused on evaluate on the relationship based, like reputation based of features. So this is the interaction I was talking about. So we're trying to break down the nonlinear relationship. So basically what we found is, what are the interaction really important here is we found the forecast horizon interact with forecast value, interact with consensus. So we use the breakdown method. This is a little bit too much to explain here, but the idea here is I keep talking about a non-relationship, interaction in the future, but how exactly we interpret from model, from the convolutional network, it's a black box. It's black box. You don't know what after optimization, what is important, what is not important. So we use this way to break down the convolutional network to show you guys the interaction we highlighted in red is the most significant interaction, which help us to understand which analyst we can trust in the future. So we horse race with human. So you can see that machine picked analyst, it's better than the human picked analyst. That's natural, right? So basically, machine picked ones are much better than human picked ones. We also use the historical consensus. So historical star means if we only look at my historical forecast error, would that beat machine? So you can see that machine outperform for the just simple historical ranking all the human picked analysts. So we talk about some cross-sectional tests, and we talk about the forecast accuracy, and you can see that when machine pick up the analyst, the next quarter. So we're talking about next quarter. The accuracy is the errors accuracy is much improved. Yeah, this is what we found empirically. And so this is the draft about the return I want to talk about. So the blue line is machine pick up the analysts. The orange line is the analysts who do not pick up the machine. So you can see that once the trading days, if the machine pick up analyst, if you follow the portfolio, you can see that if you follow them, you can generate a much higher return versus you short the analysts who you don't pick up. So you can see a huge gap between machine picked analysts versus machine not picked analysts. And this is the consensus test I was talking about. So what does that consensus mean here? If we get the 40% analyst consensus versus you get 3 people, 3 analyst consensus, you look at the difference. So right, this is a question earlier asking me. We have 3 analysts, you pick up the best 3, you get the average, versus you get 40 analysts, you get the average. You take the difference between the 2 average. What do you see? Well, we can see that predicts the return earnings significantly. That means the machine predicted ones have more incremental value in predicted future earnings. And we also test on the return test as well. You can see that people don't get it. People don't get it. The reason we see in the future earnings announcement we get about the return is because everyone follows 40% analyst consensus. Does it make sense? Before the earnings is announced, everyone follows the median of the 40 analyst forecast. Why we are saying don't follow the 40s, only follow the 3 analysts we are talking about. Use the 3 analyst consensus minus the 40 analysts consensus. The difference can predict a return. That means the difference is new information to the market, right? So let's say if everyone know the 3 analysts are the best 3, if everyone know that, we shouldn't predict any returns. We only predict returns because the market do not know what are the 3 good analysts, and we use that 3 analysts forecast minus the people's expectation. The difference predict returns in the future earnings announcement. In the future earnings announcement, yeah. We didn't quantize. We have to check. I have to check how to interpret the magnitude. Probably the standard deviation times this. I have to check. We didn't rank it. We didn't. You have to go back to check.
Okay.
Go back to check.
In the previous
Yeah.
figure you said,
Yeah.
you show the figure, like,
Right.
go back to
I doubt 3 days have 4%. That's too large for me. Yeah.
Here is like a 1.5% per year.
But this is a individual level. That one is a firm level. Does it make sense? That one is a firm level. We use the consensus for the firm machine picked versus consensus over everyone.
Yeah.
But this is an individual level. At each forecast, you follow the machine analyst.
Yeah.
Versus down. So this is a little different setting, right? Does it make sense?
Yeah.
So here you are following each analyst,
Yeah.
but over there you follow the firm.
The firm.
Yeah.
Here, if you follow each analyst, the amount of returns only 5% in a year. Not that large.
Yeah, but it's frequent, right? It's very frequent.
You mean like,
Yeah.
yeah. How did you come to like a? You mean like you invest every day or like or it's just one event?
Buy and hold.
Buy and hold.
No. Yes, buy and hold. Yeah. So so it's a firm level. So this is some of the test. I just explain some individual. So you also explain some anomalies we had earlier. So we talked about before. I want to spend some time share some of the challenge of the paper to you guys. Any questions before I move on? Any questions?
I have a question.
Yes.
Regarding the analyst skill, how large is the variation of being good in the sample? I mean, you talk about 3 trustworthy analysts. Does it change from quarter to quarter? Who are
huge variation. Good question. Huge. There's huge variation, and there's some. Very interesting. Some analysts, you should take their opinion in the opposite way. This is very interesting. We didn't dig into too much of that results, but some analysts, if they tell you this is it's a bad firm, actually every time you take their opinion in the opposite way, you get it correct. Sometimes we found that huge variation.
Always bad, or does it
always for that analyst, for that particular firm, always. So condition on the firm, condition on analyst. Yeah.
So this is more like, this is also about avoiding the bad ones, not only picking the good ones, right?
Yeah, not just avoiding the bad ones. You can flip the bad ones, which you can get good ones. So basically, someone's opinion, you just disregard his opinion. You flip his opinion, will be good opinion. That was very interesting what we found, and So just go back to your answer. Last, there's a huge variation on the.
Then last will be the started video.
Okay.
More of a connection.
Okay. So does that answer your question, Lars?
Yeah, sort of. But it's if one of the analysts are bad in one quarter, are they then good in the next?
Oh yeah,
What about that variation?
That variation is also large across firms. So basically, our model is not a static model. So every quarter we train a new model. Does it make sense? So basically, our model is time variant. So every model we train a model to make sure we pick up the timely fashion on that. So every quarter we train the stuff we're doing to see we incorporate the contemporaneous information on that. So every quarter we have a prediction. Yeah.
So unlike in the real world where humans rate humans, you become a star just for 1 quarter, and then you're not a star anymore in your model. Is that what you're saying?
For evaluate human depends on the data. If the institutional investors they value the quarter with star, then next year also evaluate the star, and that's it. If they change, then we change. So basically, for human ones, we just follow whatever the rating the analyst received. Yeah.
I guess the question sort of goes down to what some sort of transition maker for being a ML star analyst, like have a high probability to stay the star for quarters, or is it very low? Because I guess then it's a question of to the question of how much of that is really analyst skill versus how much is it that getting lucky. Yeah, then it's another question.
So let me see if I have something about that. So yeah, that's something we can look into, I think. Yeah, to see if the flipping, like the human picked versus machine picked, when they have common. Can we write it down? Yeah. So we can look at 2 things. One thing is how persistent is machine picked analyst. If they're good this quarter, will they be good next quarter? We can see the persistence of that. Another thing is we can look at the human picked analyst versus machine picked analyst. When do they overlap? When do they not overlap? That's the 2 things we can look at. Does that? That's as a comment. Okay.
In that way, you can provide.
Yeah, we can look at their persistence on their own, the machine picked, right? And we also horse race with the human picked. Okay, good. Any more questions? Okay, let me just wrap up 1 minute. I just feel normally what challenge we feel when we write this type of paper, AI stuff. The one thing is most of the time people will emphasize the theory, not the methodology. Like if I tell you guys this is the best model we have in computer science, most of the time referee will say send to computer science journal, not here. That's probably the answer, standard answer we get. So in this paper, we want to show that this has implication for the understand the information aggregation. This is information to provide the market returns. So again, this is like, I don't want to just sell this AI has opportunity for our research. I want to say it also has challenge. One is the theory part. So what kind of insights we can get from this study, not just selling technology. That's the first one. The second one is how to make the technology understandable to people who don't have a computer science background. So I use the graph, the neural network graph, but the behind the story is complicated, like each activation function, how do you optimize? So my approach, I will have my first year PhD student to read my technology interpretation part. If she or he can understand, that's where I'm stopped. If he or she don't understand, I will keep writing until either my first year PhD student understand the paper, or he or she becomes second year or third year. So either way, I mean, either way, I'm just saying this is very important. If let's say if you guys don't understand the methodology, would you be able to take this as a publication? You will not. Same as other referees. So how to make the technology interpretable to people who don't have the background, who can accept this? That's one challenging job. That's why sometimes the writing, keep writing until someone who don't have the commercial background understand the technology. That's what I'm adjusting for. So, and also adjusting the use, like some of you are like, why not OLS? So some like Lan was asking, why don't you use OLS? Why have to use neural network? Yeah, why we use this, why we use CNN, why we use convolutional network. I said we local. So we have to understand the model and justify the choice of convolutional network instead of OLS. So these are all the challenges, common challenges you have faced. People always challenge you, don't sell technology, sell theory. If they don't understand, they will not take your paper. Also, justify the choice of the model is also important. The last thing is, if you guys need more, you can go to the my website. We organize a conference with RFS, and we have 300 papers. This year we received 170. So we have 470 papers already. So if you guys are interested, you can go there and you won't find my paper there because we are not submit our own paper to the conference. But you can see my paper on my website. But you can also see what other people are doing in this area. Thank you so much. I think I got to leave. Beauty jumping. Okay, how large is the beam? Good. Okay, yeah, I think I got to leave before I miss my plane. I have a plane at 4 p.m. I think. Thanks so much, you guys. Enjoying my talk, enjoying Sweden, everything. Okay, I'll hand the floor back to Sarah.
Yeah, I just want to say thank you, Sean, for an interesting presentation, and thank you everybody for attending the seminar.
Okay.